Hey traders, let's talk about one of the 4 basic option strategies known as a cash secured put, aka a short put. A cash secured put is similar to another basic option strategy known as the covered call. Cash secured puts are a simpler transaction than multi-leg spreads. Rather than dealing with various strike prices and expiration dates, net debits or net credits, you have a simple transaction. You are selling only a put at a single strike price with a single expiration. The only complicated part is that you are taking on an obligation to purchase 100 shares per contract at the strike price should the option buyer exercise the option if the price falls below the strike price. So in order to make sure that you can fulfill that obligation, you're going to need to set aside enough cash to purchase the stock should that occur. So let's break this down in a little more detail. As we know, there are 2 types of options, calls and puts, and there are only 2 things that we can do with these options. We can buy them or we can sell them. To set up a cash secured put, you'd simply need to just sell a single put option in a stock while simultaneously setting aside enough cash in your account to cover 100 shares of that stock. You may or may not have to buy these shares, but you need to set aside the funds just in case. As the seller of the put option in the stock, you are obligated to buy 100 shares of the stock from the put buyer at the agreed upon strike price if shares trade below this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. The goal is either to have the put expire worthless and above the strike price, allowing us to keep the premium, or to be assigned and acquire the stock below the current price. The main risk with the trade is similar to outright stock ownership. That is, if the stock falls quickly, then the trade will suffer a loss. However, the loss will be partially offset by the premium received for selling the put. If the put does get assigned, the investor takes ownership with a reduced cost basis and can potentially begin selling covered calls to generate further income from the position. If you're considering putting on a cash secured put in a given stock, you should first ask yourself, do I believe that this stock will trade in a neutral to bullish direction? And am I willing to own this stock if the option gets exercised? If the answer is yes to both of those, then it may be okay for you to proceed in a trade. Put selling is not simply a buy and hold strategy. It involves thinking ahead about appropriate action and possible future scenarios. For example, if the stock price declines, then where will you sell and take a loss? It's important to remember here that the put seller bears the risk of any price declines in the underlying stock. Please remember that if you're new to options, make sure you practice in a virtual account first before risking any real money, and remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas.